We are uncovering Waste Management Inc., involved in one of the largest accounting scandals in US history in the late 1990s, related to overstated earnings. So here we go. US garbage management firm Garbage Management Inc. is listed on a public exchange. Maurice Myers, the company's new CEO, and his management group found in 1998 that the business had overstated its earnings by almost $1.7 billion. Along with numerous other senior officials, the company's owner and former CEO, Dean L. Buntrock, was found guilty by the Securities and Exchange Commission, SEC. Furthermore, Waste Management's auditors, Arthur Andersen, were penalized more than $7 million by the SEC. A shareholder class action lawsuit was finally resolved for $457 million by Waste Management. In Waste Management Inc., there were several instances of fraud committed by the firm between 1992 and 1997. Senior Waste Management Inc. officials, including founder and CEO Dean Buntrock, former President Philip Rooney, Chief Operating Officer Thomas Howe, Chief Financial Officer James Koenig, General Counsel Herbert Getz, and Vice President of Finance Bruce Tebekson, started manipulating the accounting records of the business. One of the fraudulent practices was assigning and inflating salvage values and prolonging the usable life of the company's garbage trucks in order to avoid depreciation payments. As owned assets wear out and lose value over time, depreciation expenditure needs to be reported annually in a company's financial accounts. Furthermore, the executive's failure to report costs for any drops in the landfill's value constituted further fraudulent action involving the accounting books. By doing this, the corporation would appear to be spending less money when, in fact, more money ought to have been provided for this. Subsequently, the officials declined to document the essential expenditures required to deduct the charges of abandoned and failed landfill development projects. Consequently, the financial accounts of the firm showed a decrease in costs. Furthermore, things that had no salvage value at all before were given salvage values by the officers. Stated otherwise, this would increase an asset's residual value that didn't previously exist. Additionally, Waste Management Inc. raised its environmental reserves in order to save unnecessary operational costs. Netting assisted in removing over $490 million from operational costs. Another instance of fraud involved the incorrect capitalization of a range of costs. This would postpone recording expenditures. Millions of dollars were also moved across the several line items on the company's income statement using geographical entries. In the end, the company's financial statements showed fraudulent assets, fictitious profits that were transferred into retained earnings, and no growth in liabilities. Waste Management Inc. restated its earnings for the years 1992 to 1997 by $1.7 billion in 1998, making it the highest restatement in history. This led to the development of the current Waste Management Inc. fraud controversy in 1998. A closer look at Waste Management Inc.'s 1998 scandal. Waste Management Inc.'s 1998 scandal was a result of the company's failure to meet earnings targets by expanding profits and cutting expenses. The CEOs, who were tied to the company's earnings, began to commit fraudulent activities to maintain their financial statements. If the company fell short of their earnings target, it would endanger the officers and stakeholders, who would resort to fraud to protect their lives. Compensation tied to earnings creates a culture of fraud in any occupational environment. The high-up executives, including the founder and CEO, Dean Buntrock, initiated the fraud, allowing greed to hinder the company's honest and efficient operation. The scandal highlights the importance of honesty and efficiency in any occupational environment. Waste Management Inc. had to audit its accounting records since it was a publicly listed business. For the audit, they contracted with Arthur Andersen, one of the Big Five firms. When Arthur Andersen discovered mistakes in Waste Management Inc.'s accounting records, he would suggest fixes and modifications. Nevertheless, the executives of Waste Management Inc. rejected his recommendations. The stakeholders bribed Arthur Andersen by claiming that they would get additional payments beyond the terms of their initial agreement, which allowed the fraudsters to hide their traces. In order to hide the fraud, Arthur Andersen then provided unqualified views in the audit report for Waste Management Inc. and gradually wiped off the accounting irregularities. Waste Management Inc. was bribing Arthur Andersen in addition to using their accounting records as a cover for unlawful activities. Arthur Andersen, a prominent auditing firm, was not just a company for Waste Management Inc. stakeholders. Key executives like James Coing, Thomas Howe, and Bruce D. Tebexon were all trained at Arthur Andersen. The relationship between Waste Management Inc. and Arthur Andersen was described as cozy, with pressure from the firm's close relationships with corporate clients. Corporations often hired accountants and other personnel from their auditors and accountants, leading to conflicts in the auditing process. The close relationship between the two companies allowed Waste Management Inc. stakeholders to avoid fraud due to the auditors' close relationship. As a result, Arthur Andersen was fined $7 million for the entire Waste Management Inc. scandal. The Post, Accounting Fraud Rising by CNN Money, highlighted the cozy relationship between Arthur Andersen and Waste Management Inc., which contributed to the scandal. As the fraud examiner in this case, I would suggest a few things to Waste Management Inc. Hiring a new certified executive officer would have been the first action I would have advised. The company's current CEO was defrauding the business. By allowing greed to stand in his way and linking his pay and the company's profits together, he was engaging in fraud. He is the highest authority on management at Waste Management Inc. as CEO. A new chief executive officer would have been extremely advantageous for Waste Management Inc. if he was running the business in this manner while falsifying the financial figures. The company's profits and the executive's pay would not be so closely linked under this new CEO. The recommendation is to hire a different auditor who does not have a close relationship with Waste Management Inc. officers, such as Arthur Andersen. Another auditor would have advised Waste Management Inc. on necessary adjustments to the financial statements without bribing them. Computer software to track these adjustments would have been beneficial. Constant audit checks and other internal controls should have been implemented. Another auditor would have identified red flags in Waste Management's financial statements, such as consistently meeting earnings targets, writing off millions of expenses, and holding outdated fixed assets. To eliminate the opportunity factor of fraud, other officers, such as the CFO and COA, who have direct influence on the company's financial statements, should have been replaced. To prevent fraud in terms of incentive factor, compensation, and the company's earnings should not have been intertwined, as this created a culture of fraud. Eliminating the attitude factor of meeting high profits and earnings would discourage people from creating fraud, as this would discourage them from engaging in such activities. Thanks for tuning in to another eye-opening episode on Capital Crimes, where we uncover the truth behind the dollars and cents. Before you go, fam, remember this: knowledge is power and action is key. If you're as passionate about uncovering financial wrongdoing as we are, then don't forget to drop a comment below with your thoughts, smash that subscribe button, and share this video with the squad. Together, let's keep exposing the dark side of the financial world and keep chasing the truth.